Welcome back to Squawk in the Street. Fed Chair Powell saying a rate cut could come as soon as September if the U.S. economy follows its current path after the central bank ended its latest policy meeting, keeping rates unchanged. Joining us here at Post 9 this morning to talk about the road ahead, former Dallas Fed President Rob Kaplan, now Vice Chairman at Goldman Sachs, just down the street. Nice to have you on set.
Good to be here.
Impressions from yesterday?
I think Jay Powell did exactly what he needed to do. He didn't commit to a September hike, but he set the stage for a September hike. He reminded people that the risks are now more, in his words, two-sided, more balanced, labor markets normalizing. And I think he's set up so they have the opportunity to cut in September, but only if the data continues to confirm improvement in inflation.
Meantime, today, claims highest in almost a year.
Right.
This manufacturing PMI number not strong. If NFP's weak tomorrow, will we hear more that they are late? And although that some argue that could be quickly remedied.
So my own view, and I'd say probably the view of our economists at Goldman Sachs, are the economy is weakening. Maybe the labor force is normalizing, but the economy is not falling out of bed. Now, if that turns out to be wrong, you'll see the Fed move more aggressively. But I think they're in the neighborhood of where they should be.
Does the economy need to fall out of bed to get a cut?
No.
You think it's better to be proactive?
No, I think as long as you continue to see continued moderation in inflation, particularly in the service sector. The inflation issue today is not in goods. Manufacturing being weak is confirming that goods are disinflating. The service sector is where the inflation issue is. As long as we see continued moderation, I think you'll get a cut in September. The only caution I'd give, people should not overread what the Fed will do after September. I'm not sure this is going to be a typical cycle.
What about financial conditions? I ask because I just got a quote from Moody's, which said, despite calls for September rate cuts, financial conditions are not especially tight. Banks must proactively address ongoing credit and margin challenges, even if rate cuts ease some pressures. In other words, don't count on these rate cuts to come and solve any issues with rising delinquencies or other credit quality issues.
So the issue on the positive side, credit spreads are pretty tight. They're kind of mid-cycle tight, early mid-cycle tight. To the extent banks are having credit issues, it has to do with commercial real estate and the fact that rates have been this high for this long. So one of the things a little bit of moderation on the Fed funds rate will do, it'll take a little bit of pressure off the banks. It'll make it a little easier for small business to borrow. It probably won't do much for the real estate industry yet. And the fact of the matter is, credit conditions and financial conditions are pretty robust right now.
You just said a moment ago it's not potentially going to be a typical cycle. Why not?
I think the issue is, as long as we continue to stay around full employment, and unemployment's ticked up, but mainly because of supply increases, not because of lack of demand. I think there's still good labor demand. We still have an inflation issue. And this is maybe a little bit of the disconnect between Wall Street and Main Street. Wall Street sees that we're moderately heading down in the twos. Main Street sees inflation has averaged over the last 4 years about 4.5% plus, and they're struggling to make ends meet. And so if I'm at the Fed, I want to make sure we wrestle this inflation bear to the ground. And so I'm willing to do a cut, but I want to be very deliberate, and I'm also very mindful of the fact you could have a new administration, you may have new policies. We need to assess those policies, and I think slower and more spacing would be better because there's still a lot of uncertainty.
Any concern, though, about the overall economy? I mean, this morning, Hershey says discretionary spending on chocolate. Wayfair starts to see real weakness in their customer base.
Concern, yes, and is the economy weakening? Yes. However, I think the big area of weakness is the low to moderate income families that make $50,000 a year or less. That's 60 million plus workers. They are struggling to make ends meet. When they go to McDonald's, they're going to buy the value meal, not other things. You're seeing this in other spending. There's another big group of consumers that are over 55, have a fixed rate mortgage, have financial assets, have actually seen their financial assets go up. You're seeing income and wealth inequality growing, And I think you're hearing from some of these companies, if you deal significantly with low, moderate income consumers, they're under pressure.